Hello and good afternoon. I welcome you to today's weekly market outlook here for Admiral Markets. My name is Jens Klatt. I'll be the moderator of the upcoming 45 minutes around, and we want to have a look at what's going to happen in the upcoming week, what potential drivers we find from a fundamental perspective, also what current bias is driving the market, we have some very interesting topics to cover here, especially today. I hadn't it on the agenda, to be honest, and then the PMIs from Germany, manufacturing PMIs, came in significantly below expectations at I think it's an almost 6.5 years low. Clearly pointing towards a potential recession. German yields in the Bund future, for example, dropped now to nearly 0% again. All in all, we can clearly spot that the QE program from the ECB didn't work at all. So in this regards, it's no big surprise to see the DAX being under pressure. Interesting enough, so far the technical picture hasn't changed, and so this is exactly what we want to look at. We also want to have a look at what the Fed delivered on Wednesday. They were also very dovish in her statement, what could this mean then, especially for the US dollar, but also for example, gold. But before we start, as usual, we have to have a look here at the risk disclaimer. And you have to make sure that you understand that trading with financial instruments offered by Admiral Markets carry a high level of risk, which is not suitable for all investors due to their complex nature. And before entering into a client agreement or making a transaction, please make sure that you read the terms and conditions of the service from Admiral Markets. For further information, also for the full risk disclaimer, please reach out to the website admiralmarkets.com. And if then on top of that there are further questions, feel free to contact Admiral Markets and their client service directly. We want to have a nevertheless deeper look here into now the differentiation taking place between retail clients and professional clients since August 2018, the so-called ESMA decision. What does this mean? Well, it means that there's now, especially, and this is of highest interest in this context, I think, for many traders, that there's a leverage restriction now for retail clients with a maximum of 1 to 30 in Forex majors and 1 to 20 for other currency pairs, so-called minors, like, for example, Euro-Australian dollar. Why do I mention Euro-Australian dollar? That has to do with the seasonal pattern we're currently in. And in this context, we'll also have a look at this currency pair today. And I'll not only give you an idea of the seasonal pattern we're currently in, but I can already say that today's numbers from Germany here are bearish Euro driver, which is also playing in favor of this pattern. But there's also now a leverage restriction here for CFDs on indices like the DAX 30 or also gold. And this is what's what the ESMA decision means for retail clients. Now, the differentiation between retail clients and professional clients is as follows. For professional clients, for example, there's no such thing as a leverage restriction. So as a professional client, if you meet certain criteria, there's three categories of this which have to be met. And also here in this regard, please feel free to reach out to Admiral Markets and their service directly for further information on this. If you qualify for a reclassification as a professional client, what's on top of the leverage here, probably even higher interest of retail clients is that there's a negative balance protection for retail clients, while professional clients, in case of Admiral Markets, also have a negative balance protection up to £50,000 according to their policy. Also here, feel free for further information to reach out to Admiral directly. This is me, the face to the voice you're currently listening to. I already said it at the beginning. Probably some of you heard it. I said good afternoon. I'm located in Berlin, Germany. What has this to do with the question, why Admiral Markets? It has to do with the fact that here in Germany, we refer to Admiral as the so-called DAX expert. in fact, Atma Markets has one of the most competitive and very attractive offers in case of the DAX, with a typical spread of 0.8 points during the main trading hours. There's also now a chance to reduce the spread to 0.2 and then work with the commission, which is probably of high interest for short-term / scalp traders. Also here, for further information, reach out to the website, respectively, contact Admiral directly. And yeah, one world, global offers. So I'm located in Berlin, Germany, but it's not only Germany where Admiral Markets has an office, but also around the globe. Estonia, for example, but also in London, also regulated by the Australian Financial Services, or has a financial services license, the AFSL, Admiral Markets Pty Limited. Feel free also here to reach out to the website to get further infos on this topic. So here are the contact details. And then we want to have a look here at our agenda today. I already mentioned it several times, what we want to look at, the key economic events of the upcoming trading week, but also here what's the current bias in the FX, equity, and commodity markets, and also which trading opportunities may arise. And then we switch over here to the chart. So there you can see we are currently looking at the gold price here, but we want to start with the DAX and the current price action. So 5-minute chart. In this case here, we'll go to a higher time frame in a few seconds. Currently, the DAX is again pushing toward, well, not pushing, but drifting, let's say, towards the lows from the morning. So I have to be honest. I was caught by surprise by this move in the morning, and in fact, when looking at the DAX over the last, let's say, weeks, in fact, we know that it's a very thin market environment. And why do I mention thin market environment? Well, we have seen plenty of these occasions where the market shot up in the morning or pushed down, whichever direction, and then shortly after there was a sharp reversal, and mainly it wasn't due to any news being published, but it was due to the low liquidity we currently face in the DAX. And so in the morning, that was my initial thought when I saw this move, and then I found out, okay, it has something to do with these PMIs which were published, which came in at the lowest here at the lowest level at 6.5 years. The website is tradingeconomics.com, and we can click on this and you can already see here the chart. And there you have it. There is the market IHS market Germany manufacturing PMI, which plunged to 44.7 in March, from 47.6 in February, and well below market expectations at 48. So it came really as a big surprise here, these numbers, even though we have to say, when looking at the numbers here from January, for example, we already expected a reading below 50. And 50 is the threshold in this case where we start to talk about a recession, potential recession here. And obviously, the German economic growth starts to really, how to say that? It's not accelerating, but it's the other way. It's not collapsing. That's probably a little too much, but it's definitely the economic outlook does not look so favorable anymore. Let's put it that way. Especially now with knowing that the ECB does not buy any bonds anymore in her QE program. So she stopped with the QE program from January this year onwards. Now we can clearly see, even though we have to say it's not necessarily bound to the end of the QE program, but probably the end of the QE program is accelerating this process here. So now the ECB came out very dovish already on the 7th of March, so around 2 weeks ago, now announcing a next round of TLTROs, so targeted long-term refinancing operations, or even though it's a little rough, but giving banks liquidity, to use the liquidity, so cheap liquidity, so that banks can use this cheap liquidity to give loans to especially the private sector and to somehow get momentum in this anemic growth we see here. The only problem with this program is that it's not the first time, but already the third time that they are trying to somehow get momentum going here in the loan sector, especially in the private sector then, and it hadn't worked so far, and it's very likely that it won't work again. So, and with this in mind, we are probably facing a rough period ahead, where we have potentially, from an economic perspective, potential recession forming on the horizon. And so the reaction is very clear then. You can pump as much liquidity into the system and into equity markets as you want. If at the end it does not work out, rather sooner than later, the reaction is as follows. And you see such a sharp drop here. The interesting thing about this is, why do I mention it? And we stay in the 5-minute chart. Yesterday we had a similar move, and already, by the way, beginning on Wednesday evening, when the Fed came out, very, very dovish too. So in this regards, we want to already point out what happened here. So in fact, the Fed did not hike rates as expected. They did not cut either, okay, but nevertheless, they came out as expected. What was nevertheless surprising was that they now don't see a rate hike in 2019 anymore, and only one hike in 2020. And in this context, it's probably worth to remember, where did we stand here in December? So this is now the so-called Fed dot plot, and every point here is one Fed member, if you want, and where the Fed member, the respective Fed member, sees the interest rate here. So this is the projection for the years 2018, 2019, 20, and here is the rate which the respective Fed member sees, then the interest rate. So December here, you can see that there was a clear majority for a rate hike of 25 basis points back then to 225 to 250 basis points. And then what's of more interest is, what did the projection say? And it said here, when looking at this, you can see that the majority of the Fed members saw minimum 2, if not 3 rate hikes. So every such space here is one rate hike of 25 basis points. And if you can see that here, there's the majority for 2019, which means in this case, by the way, it's 11 from 18. So it's more than 50% seeing 2, minimum 3 rate hikes, minimum 2, if not 3 rate hikes. Okay, so with this in mind, now we'll look at the March dot plot, and what you can clearly spot here is for 2019 at the bottom, you can clearly see that now the majority is at 12 members not seeing the Fed moving at all. So staying here at 225, between 225 to 250 basis points. Why is this noteworthy? Well, it clearly shows that obviously the Fed has no clue, the Fed members have no real clue about the economic outlook. And we're probably a little too optimistic about the overall economic conditions here. What's even more interesting, I have to say, is that they pointed to still strong economic growth, or solid economic growth, let's call it. It's not really strong, but and I think it wasn't the word which was used by Fed Chairman Powell at the press conference, but still solid, it's robust, and everything should be fine. Well, if this is really the case, then the question is, why did they just not only become more flexible in terms of the runoff of their balance sheet, which is not moving on autopilot anymore, but now they're flexible in this regards, but also why did they say, okay, we are not planning to hike rates anymore in 2019 and only see one rate hike in 2020 when looking at the Fed dot plot, if everything's fine? So obviously nothing is fine, and it didn't come as a big surprise that 10-year US Treasury yields collapsed nearly to new yield lows. And what's even more interesting is, that the initial reaction based on this very dovish statement of the Fed in equities wasn't bullish, but it was clearly bearish. And as you can see here, the DAX here initially reacted in a negative way into the evening, and then continued to perform bearish yesterday, at least during the European trading session. Into the evening now, then everyone was caught by surprise to see a huge reversal now on the upside. And now we come back to the morning. I have to say, after I saw this performance yesterday, and I've seen this yeah, after the retest of this breakout region in the S&P yesterday and this really sharp rise here from there higher, I have to say that in my opinion, I was really bullish for today. Well, not really bullish, but at least I saw some gains into the weekly close. And if these numbers here from Germany around the PMI manufacturing didn't come in as they came, well below expectation, I think we had a very good chance to see a bullish weekly close. So we already started very strong into the day, and then we just collapsed. And this is now a very, very bearish sign, I have to say. And then you can clearly see it here. If we now drop below 11,450, a very, very important region comes into play. And there you can see it. Unfortunately, the line is not long enough. 1 second, please. So then this region around 11,400 points comes into play. And why is this of high interest, this region? Well, if you zoom into the chart, you can see that this is the current trend support, I'd call it, which means that this is the level which is holding the sequence of higher highs and higher lows on the hourly chart in play. And if we break below that, this sequence is broken and further losses are likely. And then when we go even one sequence higher here, you can clearly see that everything below 11,400 points somehow for the days to come in the upcoming week activating the region here around 11,000 points. So this is now very, very crucial for the bulls to hold this level. If we get to see a break below 11,400 today, and if we close the week below 11,400, I think chances are really high that further losses about to happen and that we push below 11,000. Nevertheless, and this is the other side of the coin in this case, even though currently it's a very, very close call, let's say, we could and probably we can again rely on U.S. equity markets today. So I really wouldn't rule out the chance that there will be again strong buying in U.S. equities because, and now you might wonder why. Well, because there's obviously a high interest not only among the Fed to deliver some how can I say that? Some calmness. Is this true? Can we say calmness? I hope so. So to calm down the markets, but it's also that the Fed and the Trump administration, the White House, is it's somehow intervening for months now, several times to somehow try to stabilize the markets. It's to some extent becoming really ridiculous, to be honest. So in the morning, for example, Donald Trump mentioned again, did he tweet it or did he mention it in an interview? Let me just look this up right now. 1 second. He just said they are about to find a deal with China in regards to their trade negotiations very soon. That's something which happened over and over and over and over again over the last months, and it happened, in fact, so often, especially when U.S. equities showed some weakness, that you came clearly you could come to the conclusion that there is some hope that this intervention, let's call it, or such tweets can somehow stabilize equity markets, and they did. In fact, they did. And this is probably something which is showing that even if they can't really stabilize equity markets, then you'll see another manipulation to some extent, somehow the plunge protections jumping in and buying back the market, even though it's a very thin market environment still. It's a one-way street if you look at the developments here from the end of December, for example. So with this in mind, and when looking at the price action of the last days, and not only days but weeks, in fact, when looking, for example, here at the probably it's better to have it here. When looking at the 50-minute chart, for example, yesterday, that was, in fact, it was especially when looking at the bearish reaction here to the Fed announcement. So that was when the Fed came out with their announcement on Wednesday. They should hire, and then they saw there was no real walk through on the upside. But in fact, the market reversed all these gains, and that was again a sign of weakness, in my opinion. And then yesterday, for no apparent reason, to be honest, we just saw buying. This is a 50-minute chart, and this is the start of Wall Street here in this case, so 1:30 London, and we just pushed higher. There was a short exhaustion, let's say, that was around 2.5, 3 hours later, and then from there we just kept on pushing higher. And at the end of the day, from the daily lows, and these were the lows which were marked during the European trading session, and we're looking at the future market. Well, the market stood nearly 60, oh, it was 50 points higher, again, for no apparent reason. The DAX really erased all those losses yesterday. So from these lows here, we pushed to these levels into the evening here. And then when we closed, that was nearly around the daily highs, which were marked at 7 a.m. London in the morning. And so I have to be honest, I see a serious chance that we probably get to see a similar move today. So I wouldn't be overly negative right here. If this buying nevertheless is not happening, well, then we have to clearly see that there's a serious risk of the week in the DAX closing below 11,400 and the bears taking over control in the days to come. But still, we have to wait how the U.S. equity markets present themselves in the upcoming hours. So in around 1 hour from now, they start. And if we make it back above this purple line, this is again the 5-minute chart here. If we make it back above 11,500, 520 points, I think there's a serious chance in the DAX then that we can avoid such a push and we could close below 11,400 points. Yeah, so that's it on the DAX. Let's now have a look at the euro. And I think this is not very promising what we get to see right here, even though we have to say that the overall picture stays neutral, at least for the at least as long as we can trade above 112. Probably the ECB lows 1180 here. But still, the news in the morning and now also the collapse in German Bund yields here back towards 0% is definitely something which is not painting a very, very positive picture for the euro in general. And chances are definitely high that we probably keep on pushing lower here. And why I'm so skeptical is not only that I consider the ECB to be very dovish, because then we could easily argue, okay, but the Fed has been very dovish on Wednesday too. So, and they somehow probably, or this would in fact somehow favor some further gains in Euro USD. So we pushed back above 114 here. So as you can see here. By the way, why do we have these rectangles? This is a projected target on the downside. So last time we traded around 112, respectively below 111 and 80. That was in 2017. And so it's very difficult to spot potential targets on the downside when we break lower, if we really break lower. And so what I usually do then is I just look at the range in which we traded now for quite a while, for several months, and then I just duplicate it and put it here at the bottom to have a projected target, which is around 109.50 to 110 around. But let's come back to the Fed. So the Fed and her very dovish statement, a very dovish rhetoric, left 10-year U.S. Treasury yields here vulnerable to significant losses. And so with this in mind, it did not come as a surprise to see then here the euro pushing higher against the US dollar, since most of the negativeness or dovishness, let's say, of the ECB was already priced into the euro, and the euro really couldn't gain further momentum here below 112 on the downside. So now things have changed, because now this yield game reverses. Most of this dovishness from the Fed is now priced in, while the numbers from Germany in the morning now are potentially driving European, especially German yields lower. And with this in mind, further losses seem very, very likely. And this is especially true when looking at the current situation around the Brexit negotiations. That was also something, by the way, when looking at the numbers here, that's probably also a very interesting chart, just to show you how significant this data set was in the morning. Even though it's only one PMI set, it's still, or data set, but it's still the weakest reading since 6.5 years. And this is definitely a very, very dark picture from a fundamental perspective we can draw here, especially after all this liquidity being pumped into the market and not resulting in significant economic growth here. Even though the ECB wants to sell you that it was a success, obviously it wasn't. But here, this is probably even more interesting right now, and I'm still very surprised, to be honest. I'm not sure what to make out of it. I'm not saying that these guys here in the EU or in the EU Parliament here did know about the upcoming data from Germany, but there were several indications that the overall economic picture in Germany starts to darken. And so in the morning here, these PMI numbers, they're probably, so we are somehow hitting a new climax in this regards. So now the interesting thing about it is, in my opinion, that we still have not only no deal or no concessions made from the EU towards the UK in terms of the Brexit deal, but, and this is the interesting thing, is that was a tweet from Donald Tusk from yesterday. So there's currently a summit going on between the EU 27 and the UK. So the EU 27 agrees to an Article 50 extension until the 22nd of May. That's shortly before the European elections take place, if the withdrawal agreement is approved next week. So that means nothing more than next week there is another Brexit vote in the UK Parliament about the Brexit deal from Theresa May. So let's just take a step back and just think about it again. So this deal was already voted down 2 times before, and as far as I know, there have been no changes made. And the Speaker of the Parliament here, John Bercow, on Monday said that if there's no fundamental change to this deal, there won't be another vote on it. So, or to shorten things up here, so even if they vote on this agreement again, it's not just unlikely, but I think it's a complete, it's a farce, if you want, that there will be a yes now. So it's nearly 100% sure that there won't be any yes from the UK Parliament. So we can really already say, okay, well, there will be no such extension till May 22nd. But then they say, if not agreed next week, and this is the most likely outcome, then the extension is only till the 12th of April. So it's only another 2 or 3 weeks longer now, which is also completely ridiculous. And I think it's also very arrogant right now, because we have to remember the following. The numbers from Germany here, they point to a potential recession in the biggest economy in the European Union. So if we now see this economic downturn here, and on top of that, we also face a very high chance right now that we'll get to see a hard Brexit, and the EU 27 does not move and there's no concessions made. That means that also, especially Germany as an export nation here, is hit very hard by this. We know that the UK is the 4th biggest trading partner of Germany, which means nothing more than the current economic downturn will most likely accelerate into this hard Brexit scenario, and would potentially also point to even an acceleration of the overall economic worsening in the European Union in general. So, and this is something which is, in my opinion, very, very surprising. And so far, it really does not look as if we get a solution here soon, respectively, that any concessions are made. So with this statement, or with this current state in which we are here, chances are very high that there will be a hard Brexit. And this is definitely something which is not only very negative for the euro here, and also potentially pushing the euro then significantly lower, probably not only towards 110, but even lower than that. But also on top of that, when looking at pound sterling, chances are also very high that here we not only see a slight drop below 129.50 or so, below 130, but I could imagine with such a hard Brexit scenario that we could push as low as 115 in pound sterling. Or to make long things short, we should be really careful when taking long positions in pound sterling. So in fact, I have to say, I'm still positive. I still don't see that there will be no deal, and I don't see no concessions made from the EU. But when looking at the recent developments here, it seems as if, and I really call this arrogance from the EU to really think that the UK is being hit hard, which is definitely true. But nevertheless, it will rather sooner or later massively backfire and also hit the European Union in terms of economic downturn. If no such deal is found and these signs start to manifest over the weekend, well, then you should be really careful, or you should be in general very careful in regards to long engagements over the weekend in pound sterling, because you could see a significant sharp gap lower here over the weekend. And this is definitely something to take in mind. So, and in my opinion, even though we don't know how it will play out, and again, if any concessions are made or any deal is showing here at the horizon, I think then chances are still given that rather sooner or later there will be a push above 33.50, 34 on the upside, and further gains up to 136 are likely. But if no deal is what we get to see, then a sharp drop lower, similar to the one we've seen here when there was this Brexit vote, the yes, in June 2016, there's a good chance that we will drop as low as 115, probably even lower than that, depending on market volatility here, on liquidity and everything. So be really careful currently with long engagements in pound sterling, especially when it comes to positions over the weekend where no trading is taking place and where there's a high risk of a potential, in this case, sharp gap lower than in case of long positions. Let's come back to the euro here. So I've drawn a picture which wasn't very positive now for the euro, and I've also drawn a very skeptical one for the US dollar based on the Fed and her rhetoric and statement. So the question now is there any chance nevertheless to attractively short the euro right now? And I think, yes, there is. And here is the chart. So it's on euro Australian dollar, and we've entered a very interesting window from a seasonal perspective. So in fact, during the 18th of March till the 10th of April, so this is exactly what you can here find now with this turquoise window. What you can see, by the way, is what's written here. So it's 79%. So during this window, over the last 24 years, in 19 cases, so in 19 years, euro Australian dollar went lower. So it's 79% of the cases, and it went on average 358 pips lower here, with an average loss in the other 5 cases of only 166 pips, and a max loss or a max drawdown, which occurred here of 288 pips. And now to give you an idea of what you can see here in the chart, so there's now several lines, even though it's only those two here, in fact, and probably here this thin green line, which is a line I've painted into the chart, or I've drawn in the chart. The others are the order, the stop loss, and the take profit. And also here the yellow one, which is a smart line. You can use this with the add-on package, the Supreme Edition. You can download for free for the MT4, but also the MT5 on the website from Admiral Markets. Let me just probably show you here where you can find this. That's all, or probably I leave this open because now today there's also a very interesting data set with the inflation rate from Canada coming at right now. In fact, it's right now that these numbers were published. We'll have a look at it in a few seconds. But here under platforms, you can hear, or you can find the tab MetaTrader Supreme Edition. And so if you download it for free again, you can, when having the mini terminal open, you can draw a line here, a vertical one in this case. Let me just use this. And then if you click on I have only a German keyboard here, so it's is it Alt? I think it's Alt, right? ALT, I think, and the other one is ALTGR. So you can click here on this, and then a window opens here. That's another window there, and there you can close the ticket. You can activate this line as a so-called smart line in this case, and close this ticket, 100% of it here, and then you just put it at the, in this case, 19th of April 2019 in this case. So the window is open between the again 18th of March, 19th of March till the 19th of April. And then you can say, once we reach this level here, take out the trade exactly at this date then to the opening price, and trade the window, according to the numbers of the past then in this case. So you can understand this yellow line in this context. It's a smart line. Once we hit it, then the trade is taken out, respectively closed. If we are not stopped out before, respectively, we reach the take profit. And so I entered the trade here, as you can see, and then I placed the stop around 200 pips higher. So this is based on the max loss of the past, respectively. It's also based on the ATR in this case, which is currently at around 100 pips. And so I placed the stop in the middle. It's a worst case stop if you want. And then I also place a take profit level here on the downside, 350, 360 pips lower. And as you can see in this case, this is how you can explain these lines then. And this is what we're currently trading here. And in the upcoming week, respectively in the upcoming weeks, we'll have a look here, and I keep you posted on how this trade plays out. So it's a seasonal pattern, and it's on top of that, very attractive pattern too, not only since the euro can be considered weak in the current environment, but I think it's also very attractive because we have a positive swap. You can see here the trade's already open for some time, and we are also gaining money on holding this position here. So this is from not only from an expected value perspective and a seasonal perspective, fundamental perspective, very interesting pattern, but also from a carry trade perspective. So that's it on Euro Australian dollar. And now let's have a final look here at dollar Canadian dollar. And let's have a look here. The 50-minute chart. Why? Because I want to see the reaction in dollar Canadian dollar. So obviously we're pushing higher above 34. So it seems as if the inflation numbers came in as expected or below expectation. So let's switch back to the daily chart, and let's have a look here again at this article. You can find it, by the way, in the Traders Block section here, analytics, and then Traders Block below the Forex calendar on the website admiralmarkets.com. And everything I present right here can also be found in written format here, and then what to expect for this data set. In fact, I said everything which comes in here below 1.4 could take, where dollar CAD based on that could take on fresh bullish momentum with an initial target around 34.70 in the coming days. And probably the data set today delivered exactly that. Let me just have a look here. I haven't double checked it right now, how the numbers came in. And they came in. They came in 1.5. So slightly, this is interesting, slightly above expectation. Nevertheless, it's not probably strong enough to overcome the current bearish bias in the Canadian dollar. So that's also something I pointed out in the article here. it was a very weak reaction from Canadian dollar, from the loonie towards the US dollar on the very dovish Fed on Wednesday. So the cat really couldn't really profit from it. But in fact, we saw only a small drop. And yesterday, when when the US dollar took on fresh momentum here, we pushed significantly higher to new weekly highs. And today, obviously, there's now also a push above 34, based on this reading, which is, yeah, still below the target, inflation target of 2% of the BOC. And with this in mind, I think chances are very high that there will be rather sooner than later an attack at 34.70 here. This is also true, in my opinion, since Canadian dollar can also be considered a potential volatility indicator. So you can, from time to time, really spot a positive correlation between the positive correlation between the VIX, so the volatility index on the S&P 500 and Canadian dollar. So it's not uncommon that if volatility shoots higher in equities, that also Canadian dollar takes on bullish momentum. And this is definitely something also to take into account here that could act as another bullish driver then if volatility starts to push higher in the days to come, and if uncertainty is growing among market participants after the Fed delivered more fuel, let's say, or more liquidity, a very dovish stance. On the other hand, wasn't really capable of let's call it seeding new optimism among market participants. So it wouldn't come as a surprise if volatility moves higher from the current levels and market participants are starting to pay more for insurance on their portfolios. That this corresponds also with Canadian dollar pushing higher than up to first target 34.70 and above 36.70.37. So, and so that's it from my end. I just have a look here and a quick glance in the chat box if any questions arose, but so far it looks as if no questions are open. And so then it's nothing more to say from my end. Only have a nice weekend. Enjoy yourself. Take care. Talk to you again next week on Friday then, the 29th of March. We'll have another glance then. Hopefully we are not stopped out. Hopefully we hit the take profit level, depending on volatility in the days to come. Let's see how things develop here with this trade in Euro Australian dollar. And so I wish you again happy trading. Watch your stops. Have a nice weekend. Enjoy yourself. Talk to you again next week, Friday. I look forward to it. See you and bye-bye.